guys, in this video I'm going to explain how and why we use trust structures, because I get a lot of questions when people engage us to work together. They say, why do I want to invest in a trust structure? So I'm going to show you why we use them, and for this they're called SPVs, special purpose vehicles. You set up a special purpose vehicle for each property you purchase. But I'm also going to point out this disclaimer here: I'm not an accountant. Please get specialist advice before you take action on this information, because it is just general in nature and it is just to give you some ideas so that when you speak to a professional you can ask them certain questions, right? So here's me, Neil. I've got hair in this video and I'm very happy. So if me, for instance, goes out and I buy property in my own name, these properties will show up on my credit file. And this is how normal property investors get stuck at 2, 3, 4 properties, because every time you buy a property it shows up in your credit file, and generally if you're investing in 4 to 5% yield properties, you're going to be negatively geared. The bank can see that your debt to income ratio is increasing and they're going to say, sorry, you can no longer borrow any money. So what we do, and what I've been doing for the last decade now, where I've been investing in property, and what a lot of our clients do based on the information that our team give them, is they buy properties in a SPV. And the SPV is a discretionary trust with a proprietary limited trustee. So it's quite a trust with a corporate trustee, essentially, right? And I am the director of that PTY Ltd, and we buy properties in trust for this company. So let's pretend it's called ABC PTY Ltd as trustee for the XYZ Trust. Now, because I'm the director of that company and we're buying it in trust, I have to be the guarantor for this loan. But because I don't technically own it, it doesn't show up on my credit file, which allows me to continue to invest, because I technically don't own anything. I'm just the guarantor, right? So if anything goes wrong in that property, then they'll come looking for me, but I don't own anything in my own name, and I don't own a principal place of residence in my own name. And the reason being for that is, if we buy a PPR, and let's say it's worth $2 million, $25 million, 2 mil, we've got $1 million worth of debt, we've got $1 million worth of equity in that property. That would show up on my credit file to say, Mr. Gibb owns $1 million, you've got $1 million worth of debt and no one else is paying that off for him, which means from the salary that I pay myself, I've got to allocate X amount of money to that, which then lowers my borrowing capacity. When properties are held inside trust like this, you can continue to invest, because if you've been following us for a while, you know our properties on average generate 10% yield. So every time we go out, we set up a new PTY Ltd corporate trustee, and we buy another property inside that one, buy another property inside that one, buy another property inside that one, and so on. Yes, it costs you money to set them up. Yes, it costs you a lot of money at tax time to do all the tax accounting side of things. But in the early days, you might think it's a pain. But let's fast forward 10, 15 years, right? These properties have been generating serious income. You've been using the income to pay down the debt. All of a sudden, these properties are generating $100,000 a year each. And I've just done a video called How to Build Wealth Twice as Fast as Everybody Else. Check that one out and you'll understand why these generate $100,000 a year each. This is net cash flow after all expenses. Now, a trust actually pays 49% tax. It's the highest paying vehicle of tax in Australia. So what we do is, I will take that $400,000, I will load up myself up to 120k and pay, again, I think it's 32% tax in the dollar. I'm not an accountant, I'll take it back to this. I'll then bring my beautiful wife into the picture. She's got long hair in this one. And I'll pay her 120k, and she'll pay 32% tax on that, roughly. Again, I'm not an accountant. I will then take the remaining money from these trusts and I'll put them into what's called a bucket company. Why do we do this? Because that pays 49% on the dollar. We've loaded ourselves up with 32% on the dollar, and now we distribute everything into here, and this pays between 25 to 30% tax on the dollar, depending on how you're using that entity. Now, my accountant always says to me, it's not how much money you make, it's how much money you can keep from the tax man. This is a legitimate way to minimise your tax. Kerry Packer used it, Mark Boris uses it, anybody that's in real estate uses it, because it's a very tax effective way to minimise your tax, but also protects all your assets as well. Now, I know what you're probably thinking, Neil, I've got all this money tied up in my bucket company, we've just distributed over 300k into there, how do I get it back out? Well, you can set up another trust structure, and you can loan money to that trust structure to put down as a deposit on another property, and you buy another property, and you're the director, again, of that property and the guarantor. That bucket company essentially becomes your bank. You can call it your wealth trust, your bucket company, whatever you want to call it. Basically use that now to start distributing funds to different areas of your portfolio to pay down debt, buy more properties, whatever you want to do. You can also pay yourself more money from there, but you'll pay more tax. So there you go. That is why we use SPVs, special purpose vehicles. That's how myself, a lot of my clients, and a lot of my mentors who've taught me structure themselves to protect their assets and minimise the tax. And this little cheeky thing here, the bucket company, is another way again to save some good tax too. So hope that helps. Any questions, hit me up. Happy to help.